Hello, everyone, and welcome to the very first episode of the Nexus Tech Policy Explainer. I'm your host, Marie Gichuki. I'm the co-founder and lead policy advisors here at Nexus Tech Policy. And our mission at Nexus is actually to empower organizations that are looking to get into or operate in the sub-Saharan African market, be able to navigate the complex intersections of technology, policy, and governance while driving ethical and inclusive policy solutions that support a sustainable digital future for the African market. For our maiden recording today, we'll be looking at a recent regulatory shift that is actively reshaping the current tech industry, and in particular the fintech and payment services space. This is the fintech license passporting and the regional master plans that these agreements are anchored on. So before we get into license passporting, I want to give us a bit of context of what has been happening within the financial services ecosystem. For years, FSP's licensing regime in the market has been highly fragmented. Fintechs looking to operate in multiple markets have had to navigate completely separate and to a certain extent duplicative regulatory process in order to enter neighboring markets. This has forced them to rely on complex operation and duplicative compliance effort. Agreements and landmark engagements and bilateral engagements with governments and regional blueprints are helping break down these barriers. So in this episode, I will break down what license passporting is, how regional master plans and strategies such as the East Africa cross-border payment strategy and the African Continental Free Trade Area Trade Protocol are reinforming these agreements and bilateral engagements that are currently happening, what this new development means for providers, and how they actually set the stage for Africa's digital trade future. So essentially, or exactly, what is passporting? And is this, when we're talking about fintech licensing passporting, is this the same as having a passport when traveling? And the short answer of this is yes and no. And this is because basically what fintech passporting licensing framework operates on the principle of mutual recognition. This is the practice of allowing financial services providers or fintechs authorized in one country or one member state in the case of economic block-based agreement to operate in another member state or country with minimal additional requirements. So this is a preferred policy solution because FSP passporting replaces regulatory fragmentation with clarity. It lowers market entry barriers while promoting a level playing field. It also results into an expanded, it also expands market access. It increases competition, lowers prices, and the ultimate result of this is we get better services, it's more inclusive product for consumers, and also addresses challenges of duplicative regulatory process while allowing safer cross-border payment solutions. Licensing passporting is actually not a new phenomenon, and it's not new even in the African market, but we looked at global jurisdiction to be able to understand what several other markets have adapted. And a very good example of one model that has been implemented is the European Union Directive on Payment Services, that is the PSD2. This came into effect in 2018, and an FSP providing payment services currently in Europe gets licensed by its home country regulator, ensuring that it meets the minimum standard while being able to operate in another European market. This has been a major success in integrating the European payments market, allowing FSPs to operate across borders easily while protecting consumers. Global tech giants are actually taking advantage of this when then they've been able to obtain payment services provider licenses in the EU and money transmitter licenses in the US, allowing them to operate across Europe and the US at the same time. So Europe's passporting regime actually does require a high degree of harmonization, and this is part of the process that the European regulators have had to go through to review their frameworks to be able to create harmonization of their regulation and supervision requirements or mandates in able to work effectively. So I'll give a very good example of the impact of this or how it looks in the European market. So let's say, for example, you have an FSP that's licensed in Lithuania and it wants to extend its digital services to Portugal. So what this would mean is that in the case of the European market under the PSD2 directive, is that the prudential supervision, that is financial stability and liquidity, remains with the authority in the home country, while any marketing or consumer facing behavior is handled by the Portugal market. So this comes into play, especially if, as a service provider, you look to open a physical branch in Portugal. So the local Portuguese authorities, that is Bank of Portugal, would only take over the behavioral supervision. So you'd still be able to open a physical branch there, and the prudential supervision requirements would still remain under the mandate of the Lithuanian central bank, while now the consumer-facing aspect, which is all behavior and supervision, that is marketing to customers, will now be handled by the Bank of Portugal. Beyond formal passporting, other regions are actually actively fostering cross-border digital finance through other models. This is like allowing flexible regulatory innovation through sandboxing. An example of this, we have the United States and Mexico, which utilizes regulatory sandboxes that offer tailored and time-bound licenses for testing new fintech solutions. Meanwhile, we have jurisdictions like Australia and Singapore that are allowing eligible fintech firms to test services without a full license, but they still must notify the regulator, meet eligibility criteria, and adhere to strict consumer protection conditions. So African regulators are observing all these dynamics and global precedents and adapting them into their agreements and adapting these models based on the contents, unique needs, and what fits their purpose or need. Now, going back to the current MOUs that were signed in Africa. This is just showing that the regulators are moving these adoptions beyond theory and making them a reality by having or assigning bilateral agreements that now are offering fintech bridges. And these fintech bridges are not only focused on the financial services space, they are actually also involving other vital digital services and solutions. So to be able to understand why these agreements are actually very important and why they're impactful, we need to look at the data that is driving these three countries that have signed up agreements to be able to do so. So from a Kenyan perspective, we know that Kenya is considered a global financial services leader, and it has a formal financial inclusion of 85% as of 2024. And this has been majorly attributed to mobile money and also the growing fintech ecosystem. Rwanda also leads the region with a high number of financial inclusion. They are currently at 96% formal financial inclusion rate. And it's also one of the few countries to actually fully operate a functional cross-domain retail switch known as eCash that enables instant transfers between e-wallets and bank accounts. To note, Kenya also has that, but it's not fully functional in terms of not all services have been integrated. So it's certain e-wallets that have been able to integrate with banks. Ghana also represents a critical gateway to West Africa. And the recent agreement actually reaffirms their commitment to the broader idea of an integrated African market that encourages fintech innovation and investment to be able to integrate, ultimately benefiting the economies particularly the micro, small, and medium enterprises. Ghana also has an upcoming digital public infrastructure framework that is government-led, and this is part of the initiatives that aim to support this growth. To support this further, we say that on February 2025, the Bank of Ghana and the National Bank of Rwanda signed a memorandum of understanding that aimed to introduce the licensing passporting framework and cross-border payment interoperability for regulated fintech companies. Following this, also on March 11th, 2026, the Central Bank of Kenya and the National Bank of Rwanda also announced that they have signed an MOU to develop a license passporting framework, specifically targeting payment service providers. So by promoting the mutual recognition of licensing regime, this frameworks basically will facilitate the responsible expansion of licensed PSPs across Kenya and Rwanda, while also maintaining the robust regulatory oversight. So what are these agreements anchored on, and what's it forming them? So for the Kenya-Rwanda initiative, this is actually firmly anchored on the East African Community Cross-Border Payment Masterplan. And this is, as also indicated in the announcement that they shared, the Cross-Border Payment System Masterplan was officially adopted by all central bank governors who are part of the East Africa member states on 9th of May 2025. The master plan is a comprehensive 5-year blueprint that provides a strategic framework to make regional cross-border payments faster, safer, cheaper, and more integrated. It is built on 4 foundational pillars, that is, policy and regulatory harmonization. This pillar focuses on establishing harmonized regulatory environment to be able to enhance compliance, reduce risk, and promote interoperability among PSPs. The second pillar is on infrastructure development and modernization. This is focused on modernizing payment system and exploring the development of regional instant retail switch according to the digital public infrastructure principles. The third pillar is inclusivity, which is focused on ensuring equitable access for consumers and businesses across all partner states, backed by a robust consumer protection frameworks. And the fourth last pillar is capacity building, whose focus is to develop technical and regulatory expertise and explore the role of emerging technologies. So by implementing this framework, or rather the agreement, the 2 countries, that's Kenya and Rwanda, is actually working towards laying like the groundwork for deeper financial and economic integration, while aligning with the region's ambitions to establish a single market. Now, go back to the Rwanda-Ghana agreement and what it is anchored on. So the Rwanda-Ghana one is focused on the African continental free trade area. The AfCFTA, which is what the African continental free trade area is popularly known as, is a historical mandate that aims to create a single market for goods and services across the 54 African countries who are members of the African Union. So these nations, the aim is to support or drive trade between the 54 African countries to be able to support economic development. So with this, it provides a foundation and encourages fintech innovation, which will directly benefit economies and MSMEs. Bit of a context, the AfCFTA is actually built on 3 core pillars, that is trading goods, which is focused on eliminating tariffs and non-tariff barriers to boost inter-African trade, particularly in value-added manufactured products. Then there's trading services, which focuses or aims to liberalize critical service sectors like finance, transport, and digital trade to enhance economic efficiency and cross-border investment opportunities. And the third pillar is on dispute settlement mechanism, which is focused on ensuring compliance and enforcement through structured rule-based process to resolve trade disputes fairly. So passporting, basically, like the case of Rwanda and Ghana, are directly actually anchored to Pillar 2, which is the trade-in service. By liberalizing finance and harmonizing regulation, policymakers are actually paving the way for operational tools like PAPSS, that is the Pan-African Payments and Settlement System. These systems facilitate seamless cross-border digital payments, ensuring that broader goals of the AfCFTA can be fully realized. So all I've said is good, and I always say policies are just good on paper. If we don't understand what this means for the ecosystem or for the providers operating in this, then it loses meaning. So to be able to understand what this means for you as a provider and who actually gets to benefit with agreements that have been signed between Kenya and Rwanda and Rwanda and Ghana, we need to look at who benefits. So the frameworks, as I mentioned earlier, are specifically target licensed payment service providers and regulated fintech companies. This is as stated in the MOU announcements that the central banks in these three countries have shared. This, per our analysis, will be based on as it is defined in the existing regulatory frameworks in these countries. If this will change, we will now need to see what the framework categorically states, what the agreed frameworks categorically states, if they will include other categories who may not fall under the exact licensing regime as stated in the MOU or the announcement of the MOU. For those providers, that is the regulated fintech payment services providers, passporting will directly address the challenges of duplicative regulatory process. And from a business standpoint, this will reduce operational costs and eliminate the need to build duplicate compliance teams across jurisdiction. It will also allow companies to scale their operations rapidly across these different markets. We don't expect the impact to be immediate, so it's crucial to note that these MOUs just outline the commitment and steps by the central banks to develop the frameworks. What providers need to do as a matter of now is be proactive in preparing your applications or your review or consideration by the central banks. As a critical next step, you also need to ensure that your internal compliance mechanisms are airtight. You need to introduce and maintain high corporate governance standards, as this will be key in participating in these new frameworks, as regulators will also require an effective home country compliance mechanism to be able to facilitate seamless integration. Also, engaging with the central banks just to see what timelines they're working with and get more clarity on eligibility. Beyond this current agreement, what we expect to see in future and especially in the fintech space. These three countries, the bilateral agreement offers a forward-looking process that is being designed to establish a robust fintech bridge across the continent. So this is just following the Nigeria and Egypt example. Through the central banks established a Nigeria-Egypt Fintech Bridge in 2023. The landmark MOU between Nigeria and Egypt serves as a virtual African case study. The Fintech Bridge not only serves as an open market access door for fintech companies, but it also creates a deep and cooperative partnership between the regulators themselves. The central banks are actively working together to align their licensing rules, securely exchange data, and collaborate on joint innovation and talent development. By connecting two of Africa's largest economies, that is Nigeria and Egypt, they built the foundation to truly promote digital financial payments and financial inclusion. So, in future, and what we expect to see. So whether it's the connection between Nigeria and Egypt or the new frameworks that is linking Kenya to Rwanda and Rwanda to Ghana, the ultimate goal we're seeing is still remaining the same, and that's moving towards a single, disproportionate cross-border licensing regime. The policymakers in Africa are actually laying the groundwork for a resilient and unified digital financial system that will be able to drive the continent's economic future. So, as we conclude, I just want you to know that cross-border passporting represents a launchpad for the digital trade future. And for fintechs, the time to strengthen your corporate governance and also prepare for the expansion, it's now. We are here to help anyone who's looking to get a better understanding of this and how they can better prepare, to also support you in compliance assessment or just any regulatory engagement needs you might have. For now, we sit and wait to see when the frameworks will come out or what approach they'll use to support approvals for fintechs looking to operate in this new market. But this is an exciting time for a fintech be looking to get into the market. If you're new and still figuring out which market you want to enter, and you have future ambitions of operating in any of 3 markets, this is an opportunity for you to seek licensing in any of the countries with an anticipation of your growth into the other market might be less cumbersome than what we previously had a few years ago. So thank you for joining us for our first episode as we work to shape the future of tech and policy in Africa together. Goodbye.